Nice to see so many of you here this morning. Maybe we should do these results on a Monday morning every year. Not quite sure. We obviously don't have too much competition. So thanks for coming and being here with us, sharing our results for 2018. So another fantastic year from Keywords Studios, always humbled as ever by the fantastic work that all of my colleagues around the world have done to enable us to be here reporting such fantastic results. So very, very proud of the organization and the Keywordians all around the world. So revenue up 66%. And obviously, that's a nice trick, but it's even nicer the fact that we were able to keep our profit before tax in line with that as well. So profit up 65%. From an investor point of view, obviously, given that we are making acquisitions, what's particularly worth pointing out is that we have obviously used the capital particularly well, in that we have managed to achieve a 53% increase in earnings per share. We are introducing for the first time a return on capital employed measure, which I'm sure some of you analysts will get into in more detail at some point. But pleasing again that return on capital employed is in the order of 20%. So looking at some of the key achievements for 2018, and there are lots of them. First one, of course, is that we have grown our business organically by over 10%. And in fact, if you were to exclude the kind of drag that we've already talked about from VMC, where we acquired this business that was pretty substantial relative to our own size, but that came into us with no growth and much lower levels of profitability than we were used to. Had we excluded the VMC acquisition, that organic growth rate would have been 15%. In addition to dealing with the integration of VMC and all the acquisitions that we made during the year, we invested quite heavily by our standards in expanding our space around the world, and that led to the creation of an extra 930 workstations. We also made good progress in our cross-selling activities, and I know this is only one simple measure of cross-selling, but we now have 99 clients that buy 3 or more of our services. So we have 7 service lines, and 99 of those clients buy 3 or more of those services. I think I'm right in saying that we now have 4 or 5 companies that actually buy all 7 services from us as well. We also, during the year, and we announced this separately, we strengthened our management team, both from appointments from companies that we had acquired, so Sperasoft in particular, and also external hires, where we appointed a chief marketing officer for the first time. So we're also, in the numbers that you will have in the RNS, we're giving some other measures of our performance. In this case, we're highlighting the fact that our pro forma revenue for this year is, or for last year, is 265 million euros. And that is basically looking at the company had all the acquisitions that we made during the year been in there for a full 12 months. So it's a very sort of simple way in which you can derive a starting point, if you like, for 2019. So if you take sort of coming into 2019, that our baseline revenue is about 265 million. That's the way I look at it anyway. We did make these 8 acquisitions, and in addition to just obviously giving us additional revenue and additional scale, what they did in particular was to add some new services to our business. First amongst those were the marketing services, and it was those marketing services that we were featuring in the video that was running as you entered the room. So a little taster of things to come in our marketing services business. We also now are involved in music management, where we are able to provide services to our video game clients, helping them to license music, helping them to have music composed specifically for their games. And we're also in some of the more sort of back-end parts of the games business with predictive analytics and our new business Get Social that manages all of the sort of social and friend type activities for mobile games for those people that use our platform. Also during 2018, we launched Keywords Ventures, which gives us an opportunity to make strategic investments in interesting technologies or services where we believe we can leverage our strength in and our sort of global reach in the video games market to bring those technologies to our game clients around the world. So stepping back a little bit, just reminding ourselves of the market we serve and what's going on in that market, and particularly what that translates to in terms of the opportunity for outsourcing of services. So the market remains very buoyant, strong growth during the year, about 11% year-on-year growth. It's forecast from here to grow at about 9% per annum. But it's a $135 billion niche market, which makes it, incredibly interesting from our perspective. We are probably the largest service provider in the space, and yet it's such a large market, which indicates tons of opportunity for further consolidation. So the market for our services is about $6 billion, and about 40% of that is currently outsourced, 60% is still insourced at our clients. And when you think that, say, the film and television market is a market that operates with about 90-95% outsourcing, there's a sort of clear direction of travel within the video game space. So the services we do, I said that we're involved in 7 services. For those that perhaps are not quite as familiar with us as others, these services are listed here. What's particularly interesting for me when we look at this, it was only a few years ago when we were drawing the video games life cycle that we drew it as a linear picture. You would have a concept, you would go into pre-production, you would start producing the game, and then the last thing you did was you launched the game, and that was it. You then took your whole team and moved them on to another game. Now it's very much a continuous circle. No sooner have you launched the original game that you're working on additional content for that same game, and you try to keep the game alive as long as possible by bringing more content into the game. And what we do as a business is we try to provide services at all points along the life cycle of the video game. Where we do this from, you'll see our map is increasingly global. I think we're operating in 52 locations across 21 countries. And the reason we are in the places we are is because it's either close to our clients, as you will see, for instance, on the west coast of the US, or in places like Japan, where there's a whole concentration of video game developers and publishers. Ditto for centres like Montreal, which has been very successful at creating an ecosphere of game companies. But we're also in places like China and India and the Philippines, which are tremendous markets for particular talent types that we need to provide the services to our clients. So it's proximity to clients and access to talent pools that drive our locations. The people we do it for, this is pretty much a question of the who's who of the video games market. So we do serve 23 of the top 25 game companies by revenue and 9 out of the top 10 mobile game publishers by revenue. So the eagle-eyed amongst you will probably realize that there are not 32 names on that list. It's because some names are duplicated. In other words, they fall both into the sort of top 10 mobile game companies, or into the top 25 game companies by revenue. So, for the business as a whole, what does this look like over time? Particularly proud of these charts. It's always nice to see arrows pointing upwards and to the right. And as you can see, tremendous compound growth rates in terms of revenue. If we took it back to 2013, I think the compound growth rate actually increases again beyond the 61% that you're seeing there. Profit before tax, actually a little bit ahead of the revenue growth rate at 65% CAGR, and EPS very, very strong at 54% compound annual growth rate. The return on capital employed, as I said, that's a new measure that we're sharing with you for the first time. And what it sort of illustrates to me is how when we make some of these substantial acquisitions, we can see that for a short period of time, hopefully, it might depress our return on capital employed, which I think is the case here, where it's probably more BMC related than anything else. And as we fix the business, so the return on capital employed should trend back upwards to that sort of 20% mark. I personally love balance. I like the fact that our business is increasingly balanced, and we see that in a number of different ways. And balance somehow also translates, in my mind, to kind of stability and quality of earnings. So some of the charts here, this is on the one hand the number of clients using 3 or more services, which is basically a kind of a proof point that our strategy of entering into different service sectors and then being able to offer those services to our existing client base is working. The limited customer concentration graph is also very rewarding. When I think back to 2013, 2014, where we had something like 2 clients accounting for 50% of our revenues, that picture is very, very different today, with no single client representing more than 6% of our revenues, and the top 5 clients representing 25% of revenues. Revenue and margin growth, so revenue grown strongly, margin very steady at around the 15% net operating margin line. And as you can see, the revenue per service line is quite different service line by service line, as you might expect, as we grow some of the newer service lines fairly aggressively. Another way of looking at this balance that I'm talking about is this breakdown of our pro forma revenue. Now, like I said, pro forma revenue for 2018 includes the full year revenue from all acquisitions that we did in 2018, ditto for 2017. So from 2017 to 2018, we've gone from 221 to 265 million, but importantly is the mix of revenue has become increasingly sort of even. One of the highlights of that, and I think as we go into 2019, you're going to see this representing an even larger share of the pie, is our engineering services business, which on a pro forma basis accounted for 13% of revenue. The fact that functional testing has kind of apparently gone backwards there is not a true reflection of what it did. It actually grew quite substantially. It's just that as a percentage of a bigger pie, its percentage has been reduced. And on the right, just a splattering of the sort of games that we support for each of those services. So very high-profile games, and in total during the year we'll probably work on 600 or so games. So this is only a very small number of them. One possible takeaway from this, and it's not a true representation because it's not highlighted everywhere, is that we do have games where we provide lots of different services to the same games. One example of which would be something like League of Legends, where we're actually, I think, providing probably 5 services to a single game. So those can become, very valuable to us over time. I think we've gone blank. There we go. So time for me to take a seat and for David to come and talk about the detailed numbers.
I suppose back to, as Andrew opened, reassuring to report on the numbers that we gave you the update and the trading update at the beginning of the year. Obviously, revenue is up strongly at 66%. More impressively on a constant currency basis, which would have been about 258 million, giving a 71% increase. Again, I think a strong mix of service lines contributing to deliver that overall number. And back to Andrew's earlier point, I think the pro forma number for the year is quite important as well, that that we're sitting at an opening base of nearly 265 million, which gives you a sense of size and scale of what the operation is today. The other bit as well, and back to Andrew's earlier graph, is this whole aspect of balance and the delivery of the revenues. No service line is contributing more than 20% of revenues to the group total. The average is sitting at about 15%. So again, it's starting to get nicely balanced. The impact of the engineering, the art service lines that have been grown laterally in recent years through acquisition are all contributing towards that. Again, I suppose constant currency was something that we flagged up this year. To give you some context to the mix of revenues and the currencies that are in there. USD is now making up about 50% of our revenues. Euro is about 22-25%, and Canadian is about 16%. So they're the principal revenues driving, or currencies driving our revenue mix at the moment. How's this all washed down into a gross profit margin? Up strongly from last year at about 38.2 from 36.4. I think longer term, the range is probably somewhere between 36 and 38 on a normal year. Again, what's driving that is the mix of services. The higher margin art and engineering, and all kind of flowing through down into the gross margin. Other aspects from a P&L perspective that we're pleased with are obviously on the operating costs. Excluding depreciation, up from 19% of revenues to 20.7%. But again, I suppose indicative of the investment that we've been making back into the business, widening the senior management team, and growing the team overall and making an investment back into the business. Again, longer term, looking at probably about 20% being the normalized run rate going forward. Again, we arrive at our adjusted KWS profit, up 65% to 37.9 million. Again, just to be clear for anybody who's not aware, that strips out our traditional kind of costs to arrive at that: share options, amortization, FX, and costs of acquisition and integration. Again, just down at the bottom there, obviously EPS is up strongly on an adjusted, on a basic, and on a diluted basis across the board. Moving on to the balance sheet. Again, I suppose from a balance sheet perspective, net debt just at 0.4 million, so effectively cash neutral, debt neutral. 24.9 million of net cash considerations for acquisitions, including some deferred considerations from previous years, making up that total. And also the cash outlay of nearly 4.5 million relating to specific kind of acquisition costs over the course of the year. MMTC and now VGTR claims, obviously a big part because effectively they're in the main collected in arrears. If we go back to last year, specifically on MMTC, we had nearly 15 million Canadian in claims. That was a combination of our underlying business for fiscal 17 of nearly 5 million Canadian. We had about 5 million Canadian coming from fiscal 17 for VMC. And we had a further 5 million of legacy claims that hadn't been collected by VMC going back to 15 and 16. As we stand here today, we've effectively claimed, I think it's nearly 95% of all of those. so a good recovery rate. And effectively what we're carrying on the balance sheet at this point in terms of claims relates to fiscal 18. Capital expenditure, again, a strong investment back into the business. Again, if we look at this, it's sitting at about 3.8% of revenues. That's up from about 2.5% last year. Again, traditionally, we've talked about a level of 3 to 4% of an investment in CapEx back into the business on a long-term basis. Most of the investment in the 9.4 is coming through software and computer equipment. Again, art, engineering, and testing in line with their growth, the key components where we've invested back in. The studios, Manila, Montreal, Tokyo, London, and Dublin, again, expanding the facilities there and investing back into those. From a cash flow perspective, again, strong cash conversion year on year in line with last year of about 91%. Strong dividend, again, in line with our progressive dividend policy, up 10% year on year. Debtors days up marginally from last year at 47. Again, realistic level, I think, for the business is about 45 going forward. But overall, again, a strong performance, we feel, from a cash conversion perspective for the overall business. One thing just to kind of flag up, it's not that much of an impact for us, but obviously IFRS 16 and the new lease standard is in this year. Again, just so that you can kind of see the effect on any of the analyst numbers and your models. Again, very little. We've applied the modified retrospective approach. There's no cash impact. And again, it's 2019 going forward in terms of where we've adjusted the number. So our EBITDA obviously will increase because of the nature of the standard and how you reflect it. There's a net increase in interest charges, and there's a marginal decrease in the adjusted profit before tax. So again, just for illustrative purposes, just to help you bake that into your models. Guidance, obviously, again, we're expecting strong organic and acquisitive growth to drive the numbers. Again, we've made the investment back into the business in terms of capacity ready for fiscal 19. And we also expect the full year contribution of the 18 acquisitions to help drive the numbers as well. Again, CapEx having gone up, we expect an increased depreciation charge. We're looking again for robust gross and adjusted profit margins to be maintained. Interest expenses to increase as we leverage our banking facility with the tri-party banking arrangement to drive the acquisition growth. Again, we'd be looking for a slight reduction in our effective tax rate as we kind of plan across the group, and high cash conversion rates that you've seen. Again, we'd expect those to kind of continue throughout the business. We've touched on the IFRS 16 lease accounting and its impact. But again, marginal kind of impact on the numbers through that. I'll hand you back to Andrew just to go through the strategic overview.
Thanks, David. Right, so going into a little bit more detail, service line by service line, but before doing that, we should frame it in context of our strategy. So we're continuing to pursue exactly the same strategy that we've been doing for years, certainly since IPO and before, which is basically to build the world's leading technical and creative services business for the video games industry, and in so doing, become the go-to provider for those services. So that entails organic growth, which is sort of typified by our cross-selling efforts and, of course, just increasing share of spend for existing services as well. Selective acquisitions, I lose track, I think it's 38 acquisitions or something to date. But we are very selective, and trust me, we could buy a lot more businesses that we do if it wasn't for the fact that we were being A, selective, and two, getting on and integrating those businesses. And the third sort of part of it is to continually look to fill in any gaps on that services mix so that we can provide all services our clients might need during the creation and support of their video games. So individual service lines have individual strategies that they're working to. And the results of those, at least as far as relates to 2018, and to give you some sense as to the direction for the service lines in 2019, are here on these next two slides. So first up is the art services line, grew 12% on an organic basis. But actually 60% if you take into account the acquisitions made in 2017 that had a full impact on 2018, and also those acquisitions made during 2018. Marked, I suppose, by the fact that we now have 3 marketing services businesses within the arts service line. And the other thing I think which is quite nice to see in terms of progress is how well these businesses are all working together now. One proof point of that is our initiative in China, which we call One China. We have 2 Chinese businesses in the art service line operating, one called Red Hot, one called Mindwalk. Those 2 businesses are increasingly being looked upon as a single Chinese delivery capability across the 5 cities where they're present. And it's very encouraging to see the way in which those businesses are working together. And then going forward into 2019, you haven't seen us making sort of art production acquisitions for the last year or 2, but we're probably going to consider adding 1 or 2 of those during the year. We'll also be investing further in our marketing services businesses, and if we achieve enough scale in that business, we'll be looking to separate that out as an 8th service line. So be prepared for some restatement of art services businesses next year if we do achieve that objective. The other thing that we're doing is we are going to be reclassifying some art activity that we currently have within the Sperasoft business, primarily in St. Petersburg. When we acquired that business, we started accounting for that art activity under our art service line. But what's happened actually during the year is pretty much all of that art activity, rather than being made available as an outsourced service, has been consumed internally by Sperasoft in their co-development work, so their engineering work. And for others in the space that follow, for instance, Sumo Digital or whatever, to make our engineering business a little bit more comparable, we will now be including that Sperasoft art component within the engineering part of the business. In terms of engineering itself, very strong performance from this service line, 23% organic growth. Very high demand throughout 18 and into 19. A feature, I suppose, of this, which is something that Keywords has not been very well known for thus far, is actually our presence in the UK. So it's always felt a little bit odd being a UK listed company and having actually very little activity in the UK. But what you will have seen with the investments we've been making in engineering is that quite a bit of that investment has been directed to the UK. And the reason for that is that the UK is actually a fantastic base for video game development. And some of those video game companies have been sort of spun out from larger companies that at some stage closed down studios or whatever. So you've actually got pockets of very good talent that are available and looking to join a more sort of solid structure like Keywords. So all of our 6 engineering studios are actively recruiting like mad. We expect another strong year of organic growth. You also should expect further acquisitions from us in this space. I think no matter what we do in terms of acquisition, no matter what we do in terms of organic growth, we're never going to be able to capture all the demand that's out there for these services. It's amazingly busy, and it's a very sort of strong indication that a service that once was very much considered core and very much an internal activity is being increasingly outsourced. Functional QA. This one's, I need to sort of stress just how well this business has performed this year. It doesn't come across when you look at the like-for-like growth rates, because that was very masked by the impact of VMC. But if you were to strip out VMC, then you'd get a better picture of the underlying growth in that business, which has been 26%. And it's growth that continues very strongly into 2019. And the growth has been such, both through the combination of VMC but also organic growth, so that service line now is our biggest single service line. As I said, strong growth to continue into 2019. The other thing it's busy doing, if you imagine, we're very strong in North America. We're not really present at all in Asia, and we have very limited sort of presence in Europe. Actually, that's not true. We are present in Asia in a small way through an operation that we have in India, and we have very little in Europe. But we are now looking at leveraging existing facilities that we've got for other service lines in Eastern Europe. So particularly, we have an engineering-led location in Volgograd in Russia, where we are doing some testing services from. And we're also very excited by the location of Katowice in Poland, where we created a customer support operation during 2017. And our functional QA guys are actively looking at spinning up some QA services from that location. Onto localization itself, which is the sort of translation side of the coin. This business was most affected out of all the businesses by the fortnight effect. So its top line growth was held to only 3.5%, which is really a long way down compared to what the business historically has generated on an organic basis. And it saw that effect in a number of different ways, but one of them in particular was its largest single client went from being its largest single client to being, its client number 15, 20 or something in the space of about 6 months. So left it with a lot to make up for. So again, absent that, the performance has been strong, and hopefully, obviously, with that effect now largely out of the way, we hope in 2018, 2019 should be a more solid year. So it's a very homogeneously sort of run service line, and they're undertaking quite a lot of work in terms of the tools and so on they use to make themselves more efficient and to provide a more robust service for their clients. So that is, you see that in the investments they continue to make in the XLoc platform and integrating that further downstream. Also doing more and more work in the field of machine translation, trying to see whether we can make machine translation work economically for video games. It's one of the hardest nuts to crack in terms of machine translation, just because you've got this very crazy world of very high creative mixed with very complicated technology. Localization QA, flat year in absolute terms, but actually a decline in like-for-like revenue. Affected mostly by some slippages of some important projects that were expected and committed to from clients in the last quarter of 2018 that slipped over into 2019. Obviously, as you would expect, that service line is currently working on some of those slip products at the moment and is expecting to work on more of them in the second quarter of the year. So it's made a good start to the year, and obviously, as you would expect for a business that's been kind of underperforming a little bit in terms of our revenue expectations for it, we're going to be looking at ways in which we can try and sort of re-energize that business and set it back on a path to growth during this year. Again, it's a service line that's exploring this location that we seem to be doing well in Katowice in Poland. That's perhaps an opportunity for it to create another differentiated service offering from that location. And finally, but certainly not least, is player support. This was the fastest growing business in Keywords by some way during 2018. Really stellar performance from them. And it is the business that opened this facility in Katowice from scratch middle of last year and finished the year with 200 people employed in that location. And to give you some additional flavour for the strength of the growth in that business, if you were to exclude VMC, which in terms of the player support business actually went backwards during the year, the sort of underlying rate of growth for that business was 94%. So as we look to 2019, please don't expect another 94% growth from player support in 2019. That's not likely to happen. It's more going to be a question of consolidating what we've got. Of course, looking to grow the business, but the primary focus is making sure that everything we've built during 2018 is put on a very solid footing. And the challenge for this business, given that it sort of competes with the very large customer care providers out there in the market, is to continue to differentiate itself as being a game specialist provider of these services. And in that world, it stands alone in terms of its scale and capabilities. So I thought it was an opportune time to sort of remind everybody a bit about the opportunities that lie ahead of us, certainly in terms of acquisitions, but also in terms of organic growth. So to do that, sharing with you a chart that was, I think, first shared at one of our capital markets days 2 or 3 years ago. But it is quite a useful sort of reminder in that it points towards the headroom that we have in each of our service lines. So you've got the market size as estimated by us. Unfortunately, there are no sort of independent research that I know of that actually sizes this market. So in most of these cases, we've actually commissioned research to actually size the market for us. And in other cases, we've just used our own pure estimates. But all of them are large markets. Some of them, you can see that there's got very low penetration of outsourcing rates, even some markets that you would expect to be much higher. The one that stands out for me most is probably functional testing, where it's only 30% outsourced, at least in the West, and yet it's 100% outsourced in Japan. So I think there's a big opportunity there as those companies start to outsource functional testing more and more. Some of the other markets, like localization and audio, are already very highly outsourced. Having said that, they continue to grow, and as games get marketed to more and more territories on the back of mobile phone penetration, now, of course, with streaming coming up, you get the language of the guys at Microsoft and so on, who are now talking about, instead of being restricted to 200 million players that have an Xbox, they now can access 2 billion players that actually play video games thanks to streaming initiatives. So as those markets open up to game content, so it needs to be translated. So we expect those markets to grow quite fast anyway, despite the fact that outsourcing is already well penetrated. And as you can see by some indication of the number of players in each of those markets, they remain highly fragmented. Lots of opportunity for additional selective acquisitions. Before you ask me how VMC integration is going, I thought I would share this with you as a bit of a case study. We've got a couple of case studies here on integration with a slightly different flavor in each case. So for VMC, what I would say is basically the integration is done. So there's really nothing left to come from VMC in terms of integration. It was done ahead of schedule. We had a 2-year integration plan. We've completed it in a year. Significant cost reductions made, and you can't see that on a VMC exclusive basis because it's so integrated already. It's quite difficult to identify where the sort of revenues and profits are coming from. But what I can say is we made substantial reductions in management overhead, some good reduction in facility costs. And we did internalize some costs that were previously being outsourced. So a lot of progress on the cost side of the business, and that has led really to the business now generating returns which are very similar to our own Keywords returns. So roughly speaking, 15% of revenue. And basically all of the activities of VMC now run on the Keywords sort of stack. So all the tools and technology that we use to run our businesses are being used by VMC. The organization structure, the management structure and everything else has been totally aligned with Keywords, and there is total sharing of facilities and so on. So much so that we've really dropped the use of the VMC brand. Another example of this, I'm giving you the entire art service line now. So this is a service line that comprises of 5 art production studios, by which I'm talking in this case brands rather than individual locations, and 3 marketing services businesses. So those art production studios are now working incredibly well together, and you can imagine, each one of them has had a fairly sort of entrepreneurial, slightly creative head of these activities. So getting people to work together is, has its own challenges in terms of personalities and so on. But in our case, the guys have come together extremely well. It's all based on this focus around doing the best thing for the project. And if the best thing for the project means that you work across 2 or 3 studios in order to get it done, that's what people do. And it's working very, very well. So increasingly, companies are coming to us and asking for art service at a Keywords level rather than at an individual studio level. And then it's up to the art service line direction to figure out how to actually get that job done. The clients don't really mind whether there's some production happening in India, some in China, some in the west coast of the US or whatever. What they care about is getting a good, solid delivery with the right quality on time and to budget. I've already talked a bit about the One China initiative, so I won't repeat it here, but it's quite nice to see that, that coming to fruition. And then the other thing that's really sort of come of age, I think, during 2018 is this way in which we're able to marry high-touch sort of onshore services on the west coast of the US that can perhaps even have people that will go into our clients' premises, work with them hand in hand, to do some of the pre-production and planning work, and then actually manage on behalf of those clients. We, in our studios on the West Coast, will manage the engagement with the client while actually leveraging the lower cost production centers that we have in India and China. So that's quite a unique model, which we saw at the time when we started to make these acquisitions, but it's, it's really working very well right now as of 2018. And the other thing to point out again is just this point that for art services, it is sort of readying itself for the fact that during 2019, at some point, we may well spin out the marketing services line as a separate entity. A different sort of integration case study here, which is the audio service line. So We have made a number of different acquisitions in the audio service line, and there are a couple of sort of integration mini case studies I want to talk about. One of them is on the whole side of tools and sort of innovation and so on. So in acquiring these businesses, we find that people have been making their own tools to manage the asset workflow. It's very demanding in terms of asset management in audio production. And they'll have some automated tools that will help them with the casting process or with the process of QAing the audio files once they've been recorded and so on and so forth. So what we've done is we've gone around all of our studios. We've had regular sort of working groups across those studios to try and figure out which are the best starting points amongst all the tools that have been developed that we could then adopt as a group, invest further in making those solutions scalable and increasing the feature sets and so on associated with them, and then rolling them out as a kind of best-in-class solution. So there's a very different way of sort of looking at integration benefits. The other thing that's nice to see is that having only recently moved into the worlds of sound effects, sound design, music management, and original language voiceover production, we are working already on some proposals for clients where we're able to, well, they've come to us actually and asked us potentially to manage absolutely everything to do with audio across a single title, which is actually a really quite a large undertaking. And it would be, you know, really nice if we could make one or two of those work going forward, because it really brings the whole strategy and everything together in a single sort of case study related to a single game. And finally, and you know, I don't know if we touch on this a bit later, but I'm always willing to talk about it. We have established a small team of people organically during 2018 that are focused on the world of subtitling and dubbing. So this is outside of the games market in film and television, and in particular in the OTT, so the over-the-top market as represented by Netflix, Amazon, Apple, and so on. They made some good progress during the year, generating some revenues in terms of providing these services to that market. And we've also been working in a sort of some sort of hybrid content, I would say. So content for the OTT platforms that are also interactive. So we've been able to use our very deep knowledge of video games and how you deal with interactive content to actually bring something to the OTT market, which is far more cost effective than it would be had you done it in a pure sort of linear methodology. So if you cast your mind back to that map that we had, which was pretty busy, before you ask us the question, how do you manage all of that? I'm going to give you the answer. The answer lies in the way in which we have structured our senior management team and the business that sits behind them. So we run each service line as a global entity. It has its own P&L, at least down to net contribution level, and its own strategy. All the resources needed to deliver the services reside within these groups, so all of the individuals and boxes in pink. And then we have a regional overlay, which has underneath it country management structures, facilities structures, studio managers, and also highly allied to those are David's own finance department, which has a kind of regional element to it as well. Likewise for IT and HR, they all follow a sort of regional structure, highly related to the regional managing directors. And then at a sort of more global level, we have functions like marketing, sales as a single resource for the group. So rather than have sales embedded in each service line, having it central means that we're able to achieve this cross-selling in a more fluid way than we would otherwise be able to do. So it's a structure that we've had in place for about 4 years now. Seems to be working well. So continue to build on that. And it's really here that we run the business, not only the day-to-day business, but also acquisitions. So acquisitions are not done outside of this group and suddenly sort of, here you go, guys, here's another one. These people are integral to the whole process. So in selecting the acquisitions, in originating the acquisitions, in actually running the deals. These guys here tend to head up the actual negotiations and head up the due diligence activities with input from the service line directors. And then there will be a certain amount of oversight from people like myself and most notably Giacomo Duranti, who as our COO heads up the geographic side of the business. So I think that's it for me as far as looking at the 2018 business is concerned. So if we look into 2019 and beyond, we have had a good start to 2019. The first quarter is very much in line with our expectations. Personally, I think 2019 is going to be a good year for us. We're already benefiting from this, the new entrants in terms of the people that are coming into the market with streaming and subscription services and so on. We're benefiting directly there, as well as working on adapting content or producing content for those new platforms. So you should expect further good organic growth from us in 2019 and definitely further acquisitions to come. We've made 2 acquisitions so far this year, both small. That's not necessarily an indication of things to come. The pipeline is strong. We remain highly selective, but in terms of giving you some sort of guidance on acquisitions, all I would say is expect us to spend anywhere between 40 million and 80 million euros this year on acquisitions. And who knows, it might be more, but it probably won't be less. So leaving you once again with the core investment summary, in keywords being the sort of picks and shovels play on the video games industry, you have access to a large high growth market without necessarily being having to take on the risk of any particular product being highly successful or otherwise. Key drivers remain the market growth itself, this constant trend that content has to reach for ever and ever sort of higher quality bars, and with that creates more and more work. The trend towards outsourcing, which is driven primarily by the complexity and the scale of the industry. Our clients just aren't able to do it all themselves. And then the final driver for this year is this point about streaming of games or subscription services for games. That's going to just drive more demand for content. And where there is that demand for content, keywords will benefit in one way or another. We have a strong record for growth. I don't know, this is the 6th time or something we've stood up and presented results. They've all pointed to very strong growth year on year. And what's important is that we seem to be good at delivering both organic growth and acquisitions. So it's not one at the expense of the other. We maintain a great opportunity to continue to grow our services. I look at it as each of those service lines as being its own sort of growth pillar, and then each geography representing another growth opportunity as well. So it's a business which is stacked full of the building blocks for growth. And what holds all of that together, I think, is the very strong culture we have within the Keywords business, the culture that makes us Keywordians at heart, and a business model and management structure that really supports that growth. So I'm now going to put that slide up and stand here and take questions from you. I don't know who's going to choose who gets to go first.
I've got the mic, so I get to go first.
You've got a mic up the back there.
Toby Clothier, Mirabo Securities. If you go back to January last year, you've done 150 million of revenues in the previous year, and those grew by 10.1% organically, as it turned out. So you would have done 165 million had you done nothing else. But you ended up doing 250, so the extra 85, which is 34% of the total, came from people who, when they woke up on January the 1st, didn't work for Keywords, basically. Right?
I'm not sure that's the right way to look at it, because if you look at our pro forma 2017 numbers, that was 220 million. So that was the starting point for 2018. So you take 220, you've got the organic growth that sits on top of the 220, and then you've got whatever fills in for acquisitions to get you your 265 million. So the 151 is the reported number, but that's not giving you the full benefit of the acquisitions made during 2017.
Right, but surely on January the 1st, you've got the businesses you've got, and then the ones that you bought during the year then produce the 85 million uplift, no? No, because the acquisitions we bought in 2017 were only accounted for part of the period, and in particular VMC and Sperasoft. Sperasoft was acquired mid-December, and VMC was acquired in October. Those two businesses alone on an annualized basis. Right, okay, sure. So just make them pro forma. So if you do the same exercise for this year, you mentioned 40 to 80. Presume that's going to be a similar type of effect in terms of
so
business.
What we've done is giving you this pro forma number, which is 265 million. So 265 million is kind of the rough starting point for 2019. If you then apply an organic growth rate of 10 or 15% or whatever you want to do for your models, that'll give you the sort of organic growth that we would expect the business to deliver, and then the acquisitions that we make during the year will be in addition to that.
Okay, and then a related question: do you measure or disclose the staff turnover of the acquisitions you've made? I mean, what percentage of people stay, say, 12 months later?
We don't break it down by acquisition. We do measure staff turnover for the business as a whole. The staff turnover for acquisitions, I would say, is definitely not higher than the overall rate for the business. In fact, it's been really surprisingly, staff retention has been surprisingly good in the acquisitions, given that there's change, right, when you go through an acquisition. But actually, we've not suffered from staff attrition in the companies we've bought. So, the attrition rate for the business as a whole is round about 10%. So, that's not bad. It's pretty good for a business like this. Sorry, Ken.
Hi, Ken Rump from Jefferies. For you, Andrew, I wanted to ask, firstly, I mean, I still think the TAMs that you give are perhaps small, because 6 billion of outsourceable services from a 130 billion market. I think, if I went through all the big companies and added up the development budget, I'd get to a larger number.
Yeah.
Is there something that's wrong about that? Are there businesses that are never going to outsource? I mean, I guess small companies and maybe to a degree Asian companies are slightly less likely to do it for some reasons.
Yeah, I think you might be right, Ken. I think we might have underestimated the TAM, at least in particular in the engineering side of the business. I think when I first presented that chart, which was like 2 or 3 years ago, I think I had that at about 1.5 billion. Yeah. I've nudged it up to 3 billion. I don't think 3 billion is big enough. It's probably might even be double that. Somebody told me, somebody cleverer than me, that actually had gone through all of the publicly quoted companies, worked out their R&D spend, came up then with a sort of 12 to 14 billion TAM. And I don't know whether that's a better number to use than our 6 billion, but yeah, we might have underestimated it a bit.
And the related one to that, or parallel to that, is marketing's a big number now. Probably a lot of that is paying for advertising space, so to speak, and that's probably not something that you're going to get involved with, I guess. But probably we're going to see perhaps the marketing / trailer vertical split out if that keeps growing and being acquired too. Are there other parts of that? And in a way, player support's an odd category. It's not traditional development, but it's definitely a new thing.
Yeah.
And I went to Katowice. I guess we'll refer to them as working on a major game of the day. What kind of sort of terms and longevity do those contracts tend to have? Because that game's not going away, it seems.
Yeah, so it depends. I think, in the normal course, those engagements, like most of our other business, is not. It doesn't have a long contractual life, but what it does have is a long practical life, in that once you're working on one of these games, assuming the game is successful and assuming you're doing a good job, you should be working on that month in, month out, month in, month out, and hopefully your team size will grow as you start to, or as the client starts to, provide more and more services to. What essentially they're doing is they're retaining their customers by providing these services. So it's all part of the customer retention side of the equation.
And the marketing opportunity?
Yeah, so marketing is very interesting, and you would have seen we haven't come up with any market size estimates or anything in that space, but certainly from what we see, it's a large enough market. It's also very fragmented. There are lots of companies similar to those that we've already acquired out there. Again, very similar picture to all our other services, highly fragmented marketplace, good quality suppliers, but relatively small in scale. So it's a classic sort of keywords opportunity, I think.
Thanks.
I am Ed James from Berenberg. Just three from me. Firstly, on the organic growth number, the sort of current consensus basically takes your pro forma number for last year, adds on about 10.5%, and you get to where the consensus is now. How should we think about that between keywords, and if you could split sort of the keyword side and VMC, i.e. what should we expect VMC to do this year after going backwards last year? Yeah.
So I think VMC this year, the way I have it in mind, is it's going to be relatively flat, perhaps a little bit of growth there. And then for next year, it's when I would expect it to be growing at kind of keywords norms. So what you have within VMC is 4 different business lines. I know we've got a bit of attrition to come still in one of those lines, but some of the others are already starting to grow. So the net effect of VMC, if you like, for 2019, in my mind, is kind of flat. And then, as soon as we get rid of that, we see the last of the attrition, we should then get the whole thing growing at keywords norms.
And then just on the localization side, clearly there was sort of the delays caused some sort of lost revenue there, and VMC does work in that as well. Should we assume that basically that revenue is recouped at this year, so you get back to the same sort of like-for-like level as previous years, and that on a comparative basis should be pretty helpful?
Yeah, so we are already working on some of those games that slipped. So some of that work is underway or has already been completed in the first quarter. Some of it is still to come in the second quarter, and some of it, as you might expect, has gone away because the clients decided, they've missed the launch window or whatever, and so they shelved the opportunity. But yeah, I mean, basically, what you should assume is that we're having a stronger first half than we would otherwise had we not had those slippages.
Dan Ridsdale Edison. Just looking at the acquisition pipeline for this year, obviously VMC's been, I guess, more of a challenge than some of your previous ones. Would you look at doing a large turnaround acquisition again? And then secondly, obviously with the stock market being less buoyant than it was, but equally some other players potentially coming to market to compete with you. are you seeing any more competition for acquisition targets?
So the first question, would we do another sort of VMC type turnaround? The answer is yes, it's been very successful. Of course, I would love to have seen less revenue attrition than we saw, but in terms of our ability to get our hands around what was, a business of some scale and integrate that, I think the guys have done a fabulous job. Will we do another one? I don't know. The issue is that there are not that many businesses out there of scale, to be honest. So, we'll wait and see. In terms of competition for assets, in most of our business, we're not seeing any signs of increased competition. There's definitely a little bit more sort of activity around some of the development companies, but we look for particular things. In particular, we look for companies that are using engineering and game development as a service rather than having ambitions to make their own games and so on. And so that, I know that on some of the other listed game companies, at least in the UK, they are actually looking for companies that make games, that develop their own IPs and so on.
Alexander Schmidt from Librum. Two questions from me. One on organic growth. So I would just like to know where organic growth is coming from, whether it's from the addition of workstations or staff or cross-selling or upselling to existing clients. So how does that split out? And secondly, about the changes that the industry is going through, streaming and subscription services, how do you expect that to affect in terms of business lines, service lines, and how would that change the margin profile of the business?
Yeah, good questions. So the first one, in terms of organic growth, where is it coming from? I think it's coming from all of what you said. I can't break it down, not because I don't want to, but just that we don't have it broken down. Certainly, we put on 660 seats, I think it was, by the first half of the year. We've now, since in the second half, added another to whatever the number is, 270 seats to get to 930. And so that's a very strong indication of real organic growth. That's just responding to demand in the market. So you need more people to do the work and you need places for them to sit. What I am not suggesting is that those seats are being used, fully utilized across 2 or 3 shifts yet, but they're certainly being used extensively in the business. And the other place where you see organic growth obviously is in the cross-selling activities. So you take a game like Fortnite, where we were selling one service to it at the beginning of the year. We finished the year selling 5 services to that single game. That's entirely down to cross-selling efforts. So it comes in both forms, and we don't differentiate really where it comes from. Sorry, yeah. The second point was about the streaming and the split. Yes, I'd forgotten about that. So yeah, if you imagine that you are one of these new streaming companies that's entered into the market, you now need all of the sort of services that a traditional publisher would have had in the past. So you're going to need some QA services, you're going to need some certification services. You might provide localization services and so on to the game publishers that are trying to get their content onto your platform. You might provide some degree of customer support. So all of those sort of services are services which we can sell directly to those platform holders. And then there's a whole bunch of services where we are servicing the content itself that's going on to those platforms. So that might be in co-development engagements, it might be in porting engagements where we're taking back catalogue titles and porting it to the new Google platform, which is a different tech stack. And so, yeah, the additional revenues come in out of two different main sources. One is providing the services directly to the new platform providers, and the other one is, in the same way that we provide those same services to Sony and Microsoft and so on. And the other one is services to the content providers. In terms of what it means for revenue mix, margin mix, it depends on those services. So some of the services like localization and testing and so on are slightly lower margin than, say, game production or art services. But I'm not sure you should read too much into that. It'll be a good mix across the board, I'm sure.
Patrick O'Donnell, good buddy. Andrew, can you talk about what you're doing from a pricing perspective, given, I guess, your business is now moving towards an engineering, it's a big part of the business now, and what that means in terms of how far you can push the channel before developers push back against you?
So it's interesting. We haven't really done much on price for forever. So we're really operating in a market where we've held our prices, at least since 2012, for the most part, where we've acquired businesses and integrated them like, for instance, VMC, there'll be an element of price adjustment that goes on so that you're then providing a single price for the same service rather than different prices just because one happens to be called VMC and the other one keywords. So apart from those sort of price adjustments that happen on acquisition and not on all acquisitions, we've done very little in terms of pricing. I think we actually have an opportunity to at least pass on some of the wage inflation that we've so far absorbed ourselves. At some point, I think it's reasonable to pass some of that on to our clients. I don't think you're going to see us, being aggressive on pricing anytime soon. That's not really what we're about. It's not what makes us tick. We're much more interested in volume growth than price. I think in a market where demand is as high as it is, I think it's, normally you would say this is not the sort of market where you would expect downward pressure on price.
Just lastly, on the acquisitions front, in terms of the 40 to 80 million you talk about,
yeah.
Can you give a split in terms of the pipeline you're seeing from the engineering side? Is that a big part of the?
It can be, yeah. So you can imagine that there are some reasonably chunky acquisitions out there, sort of engineering companies of reasonable scale that would account for, on an individual basis, they could account for quite a large share of that spend. But the marketing services side also has some reasonable sized businesses in it as well. So. It just depends on how these things fall. We've probably got enough in the pipeline to consume all of that if all we did was engineering acquisitions. But by the same token, we've probably got enough in some of the other lines to account for it all as well. But you can expect us to maintain this approach to balance that we have. So we probably won't be buying all engineering and all in North America. We'll be buying them in different geographies and in different service lines.
Hi, it's Harry from Cantor Fitzgerald. Could you just talk a bit more about the engineering? So obviously the insourcing outsourcing split is lower, but do you think that that's hit a critical mass such that you're not sort of banging on a closed door but is that naturally going to reach a lower plateau than others just because of the that they want to keep an element of specialism in-house? If you could speak a bit about that.
Yeah, I think that's a good observation, actually. What's was very, very noticeable for me during last year is the amount of kind of inbound demand from people that had not outsourced any engineering before, now looking actively to try and work up co-development partnerships and so on. So I think they are getting to the point where they realize they just can't keep building everything internally themselves. It's just no longer practical. These games are getting so big and they're having problems finding the talent, retaining the talent, and everything else. So working with outsourced partners in a distributed production model, I think, is the way that people are looking to go in future. What's the second part of your question?
No, that was it. Just.
Oh yeah, will it ever outsource to like 90%? The answer is I doubt it. I think it's still going to be a very core discipline of not all clients, but some clients, those that actually make games, will continue to have 20, 30, 40% of this activity internally. What is interesting is if you're a new entrant, like you're an Apple or a Google or whatever, do you feel it necessary to go and make your own games, or would you actually commission games to be built for you? And if you're going to commission games to be built for you, then the answer is actually engineering and everything else can become 100% outsourced activity.
Yeah, just a couple of others, if I may.
Oh.
Going back to you thought you got away. Going back to your circular slide, sort of, becoming a continuous thing. Could you talk a bit about, let's take EA as an example, very cost heavy, sort of legacy, I can completely see how your business model appeals to them, very lumpy, high budget, that sort of thing. If we use the example of Apex Legends now, very much more sort of continuous, I don't know if you're working on that, but does this sort of evolution in the industry create a challenge in that it's more continual work for the publisher, and therefore there's a lesser argument to outsource as the needs to continually work on those titles, rather it becomes continuous rather than one-off?
Yeah, it's an interesting one, that. So what we've actually found is that, and in some ways this makes perfect sense, what clients are actually looking to do is for us to take a lot of that type of work off of their hands, that continuous maintenance and feeding of games. And I think the reason they're doing it is because they don't want to tie up their expensive, highly creative talent in maintaining a game that's already been kind of designed, concepted, created. That sort of work can be outsourced quite easily because it's not highly creative. It's not. It's more or less following a formula that's already been created. So yeah, it's interesting. I think definitely some people will say, well, this is continuous work, we can just do it ourselves. But then they become very people-intensive businesses, operationally complex, where arguably you can say the more value for them is in creating the next great IP, or concentrating on acquiring more clients or retaining clients or whatever, rather than the means of production.
Just lastly on M&A. You said 40 to 80, obviously it could be higher, low, whatever. That needs financing. Historically, you've been quite prudent in terms of how you're financing it. Mm-hmm. Your share price is now, whatever, £13.50, down from 20 quid odd.
Yeah, thanks for reminding me.
Well, reality. How do you think about these acquisitions? Do you look at it on a return on capital basis? Or would you look at it on an earnings accretion basis? How are you appraising this?
Honestly, kind of both, but neither. So they're out there as sort of sense checkers, if you like. Do they, are they going to have a dilutive effect on us, for instance? But that's not how we value businesses. We don't value businesses at all in relation to how the market values us. We value businesses based on the fundamentals of them as businesses themselves. So in terms of the share price potentially impacting our acquisition strategy, we're so far off that being a factor that it's just doesn't come into play. We're doing what we're doing because we're building this integrated services platform that requires us to make acquisitions, and we're going to continue to make those acquisitions. Now, if we were making them off a £20 share price rather than a £13.50 share price, and we're issuing equity, then yes, it's going to be a little bit less accretive than it would have been had the share price been at £20, but it's nowhere near enough for us to reconsider the strategy. Now, somebody take the microphone away from Harry quickly.
Neil Campling at Mirabeau. Can I just ask, if you look at the the industry, the shift to digital has obviously helped the publishers.
Yes.
You've seen Activision EBIT margins, just EBIT margins double in 5 years. You've seen Ubisoft go from 13 to 19%. And if you look at your slide 9, effectively your adjusted EBIT margins are essentially flat over the last 5 years. So what is the strategy? How can you take your sort of 15% kind of margins up to the 20% type level? Is there a magic formula for that? Is it a mix? Is it a mix element? Is it a utilization rate per seat element? What
no, it's not. And I don't think it's right to assume that we would have a similar sort of margin to an EA or an Activision. We're a very different sort of business. No, so first of all, we don't expect, and therefore you shouldn't expect us to be trying to get our net margin up to 20%. I mean, our net margin is a healthy net margin for the sort of business we are, given the growth rate we've got. It's definitely possible to get our net margin to perhaps 18% or something on occasion, but it's not something that we're actively pushing to do. We think a 15%-ish net margin while growing the business at 60% or whatever it is that we're doing is a pretty healthy outcome.
So if we had to focus more on the revenue growth line, in terms of your largest segment being functionality QA, that's growing sort of below the market growth. If we look at Newzoo data, 10-11% organic year-on-year growth, you've got 3 segments clearly, but if you look at your largest segment, is obviously underperforming that market growth rate. What's going to drive that back to market growth?
Well, yeah, we try to show that the reason for it growing only at 6.5% like for like was because of the impact of VMC, which is a business which we know is dragging it back. What we actually gave you as well was kind of like the picture for that business ex VMC, which is about 26% growth. So actually, that business is growing, in my mind, just the underlying picture is significantly ahead of market growth. And the reason for it growing so well is it really is benefiting from scale, becoming the sort of go-to provider, at least in the North American market for the services. Yes.
Hi, Richard Williamson from Edison. I just wanted to probe a bit about VGTR. So just to understand, essentially last year you had a relatively high VGTR MMTC catch-up, sort of relating to previous years. So essentially that has now been caught up. So you're looking at much more of a recurring basis. Does that mainly relate to the engineering? It's all correlated to the engineering revenues?
No. So the biggest part of it, still by some margin, is the MMTC grants, basically employment grants that we get in Quebec province in Canada. And that's not engineering related. It's related to our standard services that we have there, like functional QA, localization QA, some art, and player support. So all of those activities qualify, assuming the contracts with the clients and everything are qualifying, then those activities qualify for those grants. VGTR, which is a UK tax credit, when we're talking about VGTR, that's obviously relating to the UK businesses we've got, which are predominantly engineering when it comes to VGTR. So those will be companies like Studio Gobo, Electric Square, D3T, that benefit to some degree from VGTR credits.
But as you grow your UK-based engineering business, VGTR claims would
become bigger, hopefully.
That's the plan. And so one other separate question, just KWS, the ventures proposition?
Yes. So that's.
Can you talk a little bit about that?
Yeah. So we set it up last year basically because we were getting approached from companies that kind of wanted to join Keywords, wanted access to the market that we could provide, but were really not quite right for us. They were too early stage. And we were turning them away saying, hey, we don't do venture capital investing kind of thing. And then we thought, well, why don't we create it's not a fund exactly, but a little activity that would focus on all of these interesting opportunities, try and sift through them and try and spot ones where a small bit of money can go a long way in helping them develop their product. And more importantly, we can tie in a commercial arrangement where we can then commercialize their innovation and take that to our client base in a way that's going to be appreciated by our client base. So the first one of those that we did last year, we're now actually actively commercializing it right now, and it looks very promising, is a company snappily called AppSec Test, and their product is called AS Analyzer. But what this product does, it's amazing. It's totally unique. But basically, you can take any app from the Android store or from the Apple store, and you can drop it into this product, and it will run a full scan against the product to see areas where it's unlikely to be complying with the GDPR regulations. So a very neat bit of technology, and as you can imagine, I think games make up the biggest single category on the app stores. So lots of game companies should be interested in having us do the testing of their games to make sure they comply with GDPR.
Hi, Ken Rump again from Jefferies. I feel David ought to have a turn in the spotlight. Not least because I don't have enough leasing in my life. And could you talk me through how the EBIT doesn't change, but the EBITDA goes up? Something's moved from kind of other sort of admin expenses into the line between EBITDA and EBIT, evidently.
So obviously there's the balance sheet, the creation of the asset and the liability that nets out. It's straightforward enough. On the P&L, effectively you're looking at traditionally what was the lease payment going through for the property. So again, most of our leases are 5 years. So again, you're getting into a reclassification where it's depreciation and amortization now, getting reclassed plus the interest cost. So it gets moved down below the EBITDA line.
Okay,
so it's just a simple reclass
on the EBITDA margin, other things being equal.
Yeah.
7 on 300 odd. Okay, couple of other things related. On Keywords Ventures, by the way, Yokozuna doesn't count as a venture? Because it's kind of like that in a sense, isn't it, as a startup?
We acquired it 100%, so it wasn't acquired into ventures.
Okay, so should we have a number in mind, so to speak, for the cash flow of these guys might put 5 or 10 million into ventures that basically isn't going to add anything to revenue in the short term, perhaps?
What we've said is that we are unlikely to spend more than 5% of our acquisition spend on ventures.
Right. Okay, but it might be prudent to have sort of low single digits in there for kind of stuff that doesn't add to your
possibly.
revenue.
Yeah, exactly. Yeah.
Just to sort of get the cash flow right.
Yeah.
Return on capital, which is good to see both the figure and the progress, and the way you've calculated to sort of include acquisitions makes sense to me. Should we assume that acquisitions always tend to drag it down? So in a sense, a busy year for acquisitions is always going to drag it down, or does it depend?
Depends on the deal, right?
Yeah.
So, some acquisitions we'll buy, where we've got a 20% return going in which case they're not going to have a drag effect on the ROCE number. Others will come in at 10% return on capital or less, and then we move to bring those return rates up.
And then, of course, you've got the deal mix. 17 was the placing, which primarily funded VMC and Sperasoft at the tail end of the year.
Yeah, fair enough. So how you go about financing it, if at some point. Okay. And just a couple for Andrew to finish up. Firstly, co-dev, which I always don't like the term because to me it implies risk sharing, which is not what's happening.
That's not what's happening.
Yeah. Okay. And there was a decent question of would you buy another VMC in the sense of a business that needed a bit turning around. The other kind of deal that's potentially out there, particularly in Asia, is there are guys who do a lot of what you do, but also do it for the film and TV industry. Would you consider buying a business like that? Because there are a few sort of quite big ones out in Asia that do that kind of work.
Possibly is the answer. Possibly. I mean, like you saw in one of our slides, we talked about some sort of organic investment we're doing, which is looking towards the film and television industry. At some point, we've always said that that's a market that we see as being sort of closely neighbouring the video games market, and that we would look to see whether it made sense for us to enter that in a more meaningful way. So it could well be that those companies that do both film and game, or film, TV and game, become attractive targets for us as we move forward.
Okay, I've got a final one for David. You gave us a split of FX at the revenue line. What would you say were the key mismatches in cost terms?
Presumably on the USD. So USD is about 50% of revenues.
Yeah, but you've got costs in renminbi and rupees and so on.
Again, a lot of the other underlying costs move relative to the dollar as well. So
So if, so to speak, emerging markets are weak against the dollar, that's good for you.
Yeah.
Yeah. Cheers.
Oh, we've exhausted the questions, I think. So thank you all very much. Thank you for coming to listen.